What is Forex? And before we start, I'd like to let you know that, like every other industry, you don't become successful overnight. Same thing in Forex. It takes time and regular practice. Here, you'll be taught the basics of Forex and how to trade the markets. And when you become consistent and you master the crafts, I believe you'll be able to make money at your own comfort zone. Your time and commitment will be needed for your success in the Forex industry. Now, here are this of topic we'll be covering in stage 1, which is Introduction to Forex. What is traded in Forex? Who is a Forex broker? Trading time and trading section, currency pairs, forms of trading, terms used in Forex. Then I'll take you guys to the MT4 or MT5 interface. Now in the stage 2, we'll be talking about what is a P, concept of bid and ask price, what is a spread, forms of trading orders, concept of take profit and stop loss, leverage, lot size. Then I'll give you guys a brief explanation of what risk management is. Today begins your journey on how to trade the biggest financial markets in the world. So let's kick off, and we'll be starting with the first topic in our outline, which is what is Forex. So what is Forex? Forex is a simultaneously buying and selling of two different currency pairs. It is a global foreign exchange market, also known as FX, which represents the platform by which currency from one country can be exchanged into currency from another. Now this sounds like something that just came out from a dictionary. In order for you to understand what Forex is better, you need to know what we do in Forex and how we do what we do. So what do we actually do? And the most brief and simple answer to that is we make money by trading Forex. Now how do we do this? Let's say, for example, you know that a country currency is going to increase in value in the next 10 minutes. Let's use United States dollar for an example. You know that United States dollar is going to increase in value in the next 10 minutes. Are you able to see this coming? Maybe after doing some research. Then you buy United States dollar right now. Once it starts increasing in value in the next 10 minutes, your money will also increase in value. By so doing, you will make profits. So that's just a brief explanation of what Forex is. It's just buying and selling of different currency pairs. Now the size of markets. The Forex market is very huge in size, and approximately $7.5 trillion is traded daily in the Forex market, making it the largest financial market operating in the world. And of these, approximately $2.5 trillion is traded by retail traders trading the Forex market. The New York Stock Exchange, which is the second largest market, is having a daily trading volume of $169 billion. Now let's talk about who is a Forex broker. Forex brokers are firms that provide traders with access to the platform that allows them to buy and sell foreign currencies. Transactions in this market are always between a pair of two different currencies. So Forex traders either buy or sell the particular pair they want to trade. Now without a Forex broker, you and I can't access the Forex market. We can't even trade it. So that's where the Forex brokers come in. Now let's talk about what is traded in Forex. You can trade gold, silver, shares, crypto, commodities, bonds, energy, indices, and currencies. Now we're talking about the trading time and trading session. We have three major trading time and trading session, which is the Asian section, London section, and the New York section. The session names are derived from the major cities in which most of the transactions are done. The Asian section represents Japan and some of the Asian countries within it, while London section represents the United Kingdom and the countries within it, and the New York section represents the Americans. Forex is actually a 24-hour market. It is most time regarded as a market that never sleeps because it is open for 24 hours of the day except on weekends. So no matter where you are around the world, no matter your time zone, you can actually trade this large high liquidity market. Let's now get to the trading times. Each of these sessions have their own opening and closing time. The Asian session opens by 11 p.m. GMT and closes by 7 a.m. GMT, while the London session opens by 8 a.m. GMT and closes by 4 a.m. GMT. And the New York session opens by 1 p.m. GMT and closes by 9 p.m. GMT. And all sessions last for 8 hours. In Nigeria, we are using GMT plus 1, so you can note this down. Now for Nigeria time, the Asian session opens by 12 p.m. and closes by 8 a.m. in the morning, while the London session opens by 9 a.m. and closes by 5 p.m. in the evening, and the New York session opens by 1 p.m. and closes by 9 p.m. in the night. Now, here are key points to know about trading time and trading session. In London session, Euro, the Great British Pounds, the Australian dollars are one of the most active currencies to trade, while in New York, the dollar, the Euro, the British Pounds, the Japanese yen, the Australian dollar are also one of the most active currencies to trade. For day traders, the most productive hours are between the opening of the London session at 8 a.m. and the closing of New York session at 9 p.m. GMT. Concentrate your trading activities during the trading hours for the three largest market centers, which are the London session, New York session, and the Asian session. Most market activities will occur when one of these three markets are open. Some of the most active market time will occur when two or more market centers are open at the same time. This is because volatility is always more when two or more sessions are open. So as you can see on the image right here, you see that we have the London session and we have New York session. Now between both of them, you see where I wrote both session overlaps. So whenever London session and New York session overlaps, there is more volatility in the markets. And in forex markets, more volatility means more money. So as a forex trader, you wouldn't want to trade the quiet markets because there won't be much fluctuation, and it's those movements that makes money for us. You will come to understand this soon and know what I mean. For example, by 1 a.m. Nigerian time, London session and New York session will be open together, and it would have more volatility than someone that is trading at 10 p.m. Nigerian time because the markets will be quiet at that time. Now here are terminologies used in Forex. Just like every field you try to learn, you would have to get accustomed to these terms and terminologies. So also in the field of Forex, you would need to learn about the terminology so as to be able to communicate with the market analyst and also with your fellow traders. You may be among the gathering of Forex traders, but you wouldn't understand a dime of what they are saying. This is because you don't know the terms that they are using. So that is what we'll be learning in this section. Now, to go long means to buy, and to go short means to sell. So if a trader tells you that he went long on a currency pair, he meant that he bought the pair. While if they tell you that they short a currency pair, it means that they sold the pair. Soon, you will get to know that all we are doing in Forex is actually buying and selling, just like I told you earlier. Now, the next terms are bullish markets. A market is said to be bullish if the market is going upwards. And we have bearish markets. A market is also said to be bearish if the market is going downwards. Now, when someone tells you that a currency pair or a commodity is bullish, the person is simply telling you that it's going up. While on the other hand, if the person tells you that a currency pair or a commodity is bearish, the person is actually telling you that the currency or the commodity is going down. We have another abbreviation for bullish, which is bulls. This means buyers in Forex, while bears means sellers in Forex. We also have another terminologies, which is ranging or consolidating markets. A market is said to be ranging if it does not have any particular direction. It is neither moving upwards nor downwards. During this period, there are swing in price movements, often between levels of support and resistance, as the price bounces between boundaries of a particular range. Note, you can say that the forex market is taking a rest before it continues, but to me, there is nothing like the forex market taking a rest. It is simply accumulating orders. Now we have another terms, which is trending markets. A market is said to be trending if it has a direction. It is either moving upwards or downwards. So you can hear people say that a market is trending upwards or a market is trending downwards. Now let's talk about types of trending markets. We have upward trend. An upward trend develops when the market is making higher highs and higher lows, while a downward trend develops when the market is making lower lows and lower highs. So as you can see on the image right here, you see that the upward trend is the one with the blue line where the market is making lower lows and lower highs, while the downtrend is the one with the red line where the market is making lower lows and lower highs. The next terminologies that we'll be looking at is currency pairs and their names. Also, most of the currency pairs have specific names in which they are called. Now we'll get to know them soon. Example, the dollar is sometimes called greenback, while the pounds is called the cable, and the New Zealand dollar is called the kiwi. The Australian dollar is called the Aussie, while the Canadian dollar is called the loonie, and oil is sometimes referred to as black gold. We'll get to know them as we go along with the training. It's just to get you familiar with the most popular ones so that when you see your fellow trader discussing, you will tag along easily. And the next we'll be talking about is forms of trading. There are basically two forms of trading in Forex. We have the fundamental analysis and the technical analysis. Now let's start with the first one, which is the fundamental analysis. Fundamental analysis, this is also known as news trading. Here, you are analyzing the Forex market with respect to the news. Just like it's been said that news is what moves the market. Every day, various news are being released by these major countries, and they either positively or negatively affects the currency pair involved, and then you make your trading decision based on the news released. We see all this news on forexfactory.com, Bloomberg, or CNBC. And also, your MT4 app has a summary of news section. So this gives you a summary of this news. I will come to see them later. Now, whether the news is positive or negative, as a forex trader, that is none of your business because you make money both ways, only if you are in the right direction. We would be discussing an important news release by the United States. Even though there are news released every day, there is what we forex traders call the king of all news, and it's called NFP, meaning non-farm payroll. This is the news released by the United States of America. Among all the news released by the US, this is the highest because it causes the most volatility in the markets. Non-farm payroll is one of the biggest news in the forex market. Let's start with understanding what NFP is. Let's talk about what the news entails. It is a news that contains various data statistics released by the US Bureau of Labor and Statistics. It is very influential as an indicator of US economy because of the US Federal Reserve makes monetary policy decisions based on this data. Hence, some investors, financial analysts, forex traders, stock traders make trading decisions with the news, and it is released every first Friday of the month by 8:30 a.m. Eastern Standard Time, which is equivalent to 1:30 p.m. Nigerian time. Moving on to the second one, we have technical analysis. This form of trading is when you analyze the market using SMC, which is smart money concepts, indicators, chart patterns, candlestick, Fibonacci, support and resistance, pivot points, and Elliott waves. Now, when you use any of the above to analyze the market, it is called technical analysis. Majority of what we listed here is actually a technical analysis. It is the most popular form of trading. This is because high volatility news is not released every day, so you can't just depend on fundamental analysis alone. So as a forex trader, you must learn how to trade the market using technical analysis, because high volatility news like NFP is not going to be released every day, so you have to learn how to analyze the market and trade in the absence of any major news release. That's what makes you a complete forex trader. Next on our outline is currency pair. It involves two different currencies being paired together. Now, let's talk about types of currency pair. We have major currency pair, we have minor currency pair, and exotic currency pair. Major currency pair are pairs that involve US dollar, and minor currency pair are pairs that do not involve the United States dollar, while exotic pairs are the pairs that involves one of the major currencies. We are now entering into the practical section of Forex, where you all will be seeing what we do online. For this session, we'll be needing our MT4 app, so you can go to your App Store or your Google Play Store and download the app. Now, when you download the app, you see this interface. Once you open up the app, this is the interface that you see in the image right here. Now, let's talk about currencies and their names. We have EUR, which is Euro, USD, which is United States dollar, GBP, which is Great British Pounds, CHF, which is Swiss franc, NZD, which is New Zealand dollar, AUD, which is Australian dollar, CAD, which is Canadian dollar, and JPY, which is Japanese yen. These are some of the list of popular currencies traded in the forex markets with their abbreviation and full meaning, as you observe on your MT4 or your MT5, and it is mostly written as their abbreviation. Also, beside each of these currency pair, you will see some set of numbers written by the side. Just focus on the first number for now. Now let's continue. If you look at those currencies listed right there, you will discover that they are listed in pairs. Just like in the image right here, you see GBP, USD, Euro, USD. They are listed in pairs. Among those pairs of currency, the first currency within the pair is called the base currency, while the second currency within the pair is called the quote currency. An important thing to note here is that the base currency is always stronger than the quote currency, with few exceptions, and we would see why soon. So let's take a look at Euro USD as an example, which is the first currency pair on this image right here. Euro is stronger than the United States dollar. I believe we all know that. So hence, Euro is the base currency, while USD is the quote currency. Another example is USD JPY, which is the last currency on this image right here. US dollar is the base, while Japanese yen is the quote, because US dollar is stronger than Japanese yen. For example, Euro USD is showing 1.0890. That number is telling you how many units of the quote currency you would need to get 1 unit of the base currency. I will explain in details now. Let me use a local scenario to give you guys an example. If you have a currency pair between USD and Naira, example USD NGN, and it is showing 700, this is first telling you that USD is stronger than Naira, hence USD is the base and Naira is the quote. Then the next important thing is telling you is how many quote currencies you will need to get 1 unit of the base currency. So in this case, you will need 700 Naira to be able to get 1 USD. So that is what that number by the side is always telling you. It is telling you how many quote currencies you will need to get 1 unit of the base currency. I believe this is clear, but let me give you guys another example in the chart just to make it more clear. Let's take a look at USD JPY, which is the last currency pair on this image right here. In the image, it is currently at 158.54. It is currently telling you that you will need 158.54 Japanese yen to be able to obtain 1 US dollar. Just like I told you guys that the base is always stronger than the quote. There are occasions in which the stronger ones are written at the second pair. Example, you close AUD USD. US dollar is stronger than Australian dollar. And we also have another example, which is NZD USD. US dollar is stronger than New Zealand dollar. And we have another one, Euro GBP. Pounds is stronger than Euro. Now, when you see these few exceptions, don't bother too much about why the weaker one is written first, even though it's quite glaring that the quote is stronger. What you just have to do is to take note of them. It doesn't affect your trade. It's just for the knowledge sake, so you can take note of them or not. They are the pairs which I listed above. However, apart from those few exceptions, generally in Forex, the base is always stronger than the quote. Also, no matter which one is written first, always know that the price you see beside it is how many of the quote currency you will need to get 1 unit of the base currency. We will now move to another very important part of Forex, so let's listen closely here. This is where many people always ask questions. However, for a foundation to be strong in Forex, you need to grab this concept. And the question is, when do you buy and when do you sell? Now, this is where a lot of people get confused because they know nothing about the markets yet. Now, let me tell you this. You buy when you know that the market will go up, while you sell when you know that the market would go down. If you notice, I carefully use the word would. I didn't say you buy when the market is going up. Assuming I said that, I will still be correct, but you will get more confused. You will start asking who buys any item when it's going up. Now, as usual, I will use a local scenario to explain these topics. By the time I'm done, this seemingly complex concept will look very easy to you. So let me explain to you guys what we are actually doing in Forex in very simple terms. Just follow me here closely. If you are doing anything else, just focus from now onwards. Now let me use this analogy to explain what I mean. I will use two names in this brief analogy. Name one will be Buhari. He is the former president of Nigeria. And then two will be Tinubu, the current president of Nigeria. Now let's get to the analogy so as to understand in a layman's way on how forex actually work. Now when Buhari was in power, dollar was at the time around 460 naira to 520 naira. Let's just take the average and say it was 500 naira. Now when Tinubu entered power, some of you will recall that around 2023, at some points, dollar shot up to 1,500 naira per one. Assuming you knew that dollar would appreciate against naira like this and you had 2 million naira lying fallow in your bank account, you knew from your experience as a forex trader that certainly governments can weaken a currency pair. And you used this your 2 million and bought dollar and kept it in 2016. It will give you about $4,000. Now 1 year later, dollar just escalated to 1,500 naira per dollar, and you went to the bank to cash out your $4,000 and exchange it back to naira. It would now yield you 6 million naira. Remember, you just stopped 2 million naira. That means you made 4 million naira profit by buying dollar with your 2 million naira when it was 500 naira per dollar. Now ask yourself, did you use that 2 million naira to do any business? The answer is no. You practically did nothing. What you just did right here was forex. You leverage on the fluctuation of the price of dollar to naira to make yourself money without doing anything. You just sat at your home while the foreign exchange market did the job for you. This is basically what we do in forex. And this brings us to the end of stage 1. We'll now be moving to the stage 2. On to the next stage, stage 2, we'll be talking about what is a PEEP, concept of bid and ask price, what is a spread, forms of trading orders, concept of take profit and stop loss, leverage, lot size, risk management, and common mistakes made by traders. So, the first topic in our outline, what is a PEEP? A PEEP is the acronym for percentage in points. A PEEP was typically defined as the smallest price change that the currency can move. A PEEP is a unit of measurement that explains the change in value of markets. PEEP is the bedrock of everything. I repeat, everything we are going to be doing in Forex. So if you miss the concept of PEEPs right here, believe me, your foundation is going to be very shaky all throughout your Forex journey. Because currencies are gauged in PEEPs. Trade orders are placed in PEEPs. Profits are calculated in PEEPs. Your losses are also calculated in PEEPs. Practically, everything we are doing in Forex involves PEEPs. So take your time to understand this very important topic. A PEEP is also the smallest unit in which a currency pair can change. It can be said to be standardized unit and the smallest amount by which a currency pair in Forex makes a change. It is just like the cell of Forex. Though, as you go further, you will learn that there are smaller version called micro PEEPs. But let's not get anything complicated for now. Let's not get so hard to calculate it. Mind you, this is where I need maximum concentration from you all. So if you are distracted before now, please stay focused from now onwards. For most currency pairs in Forex, we start calculating the PEEPs from the 4 decimal place. However, there are a few exceptions. We will start with the general ones before we go to the exceptions. So before I start, the PEEP is being calculated starting from the 4 decimal place. So ignore the number superscript beside all the pairs. As you can see on Euro USD, we have 1.0890. Then we have a number superscript of 2. So ignore the number 2. So from the GBP USD in the image I uploaded above, which is right here, you start calculating the PEEP from the 4 decimal digits there, which is 6. Now after the point, you see that we have 2956. 6 is the 4th decimal number. Currency moves generally in Forex are measured and calculated in PEEPs. So if GBP USD moved by 2 PEEPs, we would get 1.2958. Remember, it's at 1.2956. So if it moves by 2 PEEPs, we will get 1.2958. So how did I get 1.2958? I added 2 to the 4 decimal place number there, and it increased from 6 to 8. So if GBP USD, which is currently at 1.2956, makes a move of 2 PEEPs, its new value will be 1.2958. Remember, we're not considering the raised to power because it's just a continuation of decimal. Let's still have another example. Let's take a look at NZD-USD, which is New Zealand dollar versus United States dollar, which is currently at market price of 0.6056 in the image I uploaded. Now, if NZD-USD makes a move of 4 pips on the current value of 0.6056, its new value will be 0.6060. Now, how do we get 0.6060? We added 4 to the 4 decimal place number there, which is 6, and it increased by 4. Now, this is just a shortcut. Let's get a recalculation of how to calculate pips in Forex. A pip for the 4 decimal place unit is actually 0.001. So we'll use the second but long method to do the two calculations we did above. For the example 1 we gave where GBP USD moves by 2 pips, the actual calculation is 0.0001 times 2 equals to 0.002 because it moves by 2 pips. So you times the 0.001 times 2. That will give you 0.0002. Therefore, you add 0.0002 with your calculator to that original value of 1.2956. We will now have 1.2956 plus 0.0002 equals to 1.2958. You see that this method looks longer, though it's the real way of doing it. We still got the same answer. Now, for most currency pairs in Forex, the pip calculation start from the 4 decimal place. Now, there are some currency pairs that are not up to 4 decimal place. Some of them have specific ways of calculating them. Example of those pairs are JPY pairs. Example, USD JPY, Euro JPY, GBP JPY, AED JPY, and NZD JPY. Another popular example is gold, which is also known as XAE USD. So let's start with the JPY pairs first. For JPY pairs, example USD JPY, the pip calculation starts from the second decimal place digits. If you notice, you see that it's not up to 4 decimal place like others that we did before. So let's see for some examples. From the image of USD JPY, it is currently at 158.49. From that value, if it makes a move of 2 pips, the new value will be 158.51. How did we get this? We started by adding 2 to the second decimal place number, which is 9, and it increased by 2. That's how we got 158.51. Now let's go to the long method. For a long method, you should take note that for JPY pairs, 1 pips equals to 0.01. So let's use the long method to solve the example. Remember that JPY pairs, 1 pip equals to 0.01. Hence, from the above example, since it made a move of 2 pips, we have 0.01 times 2. That will give us 0.02. Now, adding 0.02 to the original figure, it will now become 158.49 plus 0.02 equals to 158.51. That's the same answer we got above. Let's now get the last exception, which is gold. By seeing how it calculates pips on gold, which is also known as SAE-USD, gold is represented as XAE-USD because the chemical formula for gold in the periodic table is AU. So some brokers write it as XAE-USD instead of gold. From the gold pair in the image, the price is currently at 2435.71. If it makes a move of 5 pips, the new value will be 2436.21. How did we get this? Let's get to the long but accurate method. For gold, 1 pip movement is equals to 0.1. Hence, for that 5 pip move, we have 0.1 times 5. Adding this 0.5 to the original value of 1698.35, we have 0.5 plus 1698.35 equals to 1698.85. I hope you understand this because this is just the long method, but it's more accurate so that you won't get confused by adding 5 pips to the original value of 2436.21. So you just use the long method, and you can also use your calculator just to get the accurate number. Now, I'll be giving you guys an assignment to do, because in order for you to understand this concept very well, you need to do some exercises. So the assignment one will be, if XAUSD at a coin's price of 2435.70 makes a move of 10 pips, what will be its new value? Assignment 2, if EURJPY at a current price of 172.82 makes a move of 20 pips, what will be its new value? At the third assignment, if GBP/USD at the current price of 1.2970 makes a move of 15 pips, what will be its new value? Now, when you are done with this assignment, you can just drop the answers in the comment section, and I'll let you know if you are right or wrong. If you are wrong, I'll let you know and give you a correct answer. If you are right, I'll also let you know that you are right. The reason why I'm giving you guys this assignment is because you need to understand the concept of pips very well, because this is where you calculate your profit and also calculate your loss. So if you do not understand the concept of pips, trust me, your foundation is going to be very shaky in the forex market, just like I said previously. Pips, just like I said, is the bedrock of everything we're doing in forex. Every movement in forex is in pips. Your profit are calculated in pips. Your loss is also calculated in pips. You will understand more on this as we go on. We are taking everything bit by bit. For those that ask how is pips formed and how do we get the numbers, generally the forex market is in constant upward or downward movement, and each movement it makes is in pips. Now let's talk about concept of bid and ask price. You may be wondering, why are there two prices beside each quote? Let's now get to what they mean. Bid price is the price that buyers are willing to buy, while ask price is the price that sellers are willing to sell. We would break it down now. Bid price is on the left, while ask price is on the right. As usual, I will use what is happening around to explain this concept. Let's say you receive $10,000 from a friend abroad, and you walk into a bank to exchange it. Bank will tell you that the latest CBN rate is, let's say, 700 naira. So they will give you 7 million naira as an equivalent to $10,000. Now let's say the next day you walk into the same bank. Maybe you had an emergency and you needed to travel abroad, and you are requesting the same $10,000. They will not tell you that their own bank rate is 720 naira. So you will now have to pay 7.2 million naira for the same $10,000. In this situation, 700 naira here is the bid price, while 720 naira is the ask price. That is how banks make their own money. They just made they just made 200,000 naira profit from you in just a space of 24 hours. In forex, the bid and ask price works same way, however, not as exuberant as the ones banks exploit us with. The difference between these two in forex is just in points. So the bid price is the price that buyers also in forex are willing to buy, while the ask price is the price that sellers are willing to sell. Here, buyers and sellers are not human beings, it is the market in this case. You buy from the market and sell to the market. So the meaning of this above is that when you place a buy order in forex, it will activate for you using the ask price. Remember that the ask price is the price that sellers are willing to sell to you, who is the buyer, while in reverse, when you place a sell order in forex, it will activate for you using the bid price. Remember that the bid price is the price that buyers are willing to buy from you, who is the seller. Let's relate it to our example of bank I gave above. When you brought your $10,000 to the bank, you are the seller at that instant, while the bank was the buyer. So they gave you their bid price, which is 700 naira, because that is the price they are willing to buy. While in reverse, when you came back the next day and you want to travel for an emergency, you now became the buyer, no longer the seller. You needed to buy dollar to travel urgently. Now, the bank in this case became the seller. So they gave you the dollar at their ask price, which is the price that sellers are willing to sell. Remember, they are now the seller. Remember from the example I gave above, 720 was the ask price and is bigger than the bid price, which is 700 naira. Let's now move to the next concept related to them. What is a spread? Spread is the difference between the bid and ask price. In the example I gave above, the exchange rate, which is 720 minus 700 equals to 20 naira. The spread right here is 20 naira. That is the profit of the banks. So also in Forex, the spread is the profit of the brokers. However, in this case, it is very small because it is measured in pips. The spread varies between trading sessions. When the volatility is high and many markets are open at the same time, the spread is always small, meaning that you pay banks lesser commission. That is another advantage of trading when many markets are open. However, when only one market is open or the volatility is low, the spread are always high. So this is how spread works. Now let's talk about another important concept, which is take profit and stop loss. Take profit and stop loss are forms of market orders. Let's start with take profit. As a trader, you will not always be online monitoring all your trades, just sitting in front of your laptop all day. Some of your trades may stay over the night, some may last for 2 days. You might have to go somewhere. So you have many engagements. That's where market order comes into play. Take profit is a form of market order that tells your broker to close your trade for you and lock in your profits when your trade moves to a certain number of pips in your desired direction, even if you are not online. Remember, in Forex, we are always doing two things: buying and selling. Let's take a scenario when you are buying and give an example. Let's say you enter the currency pair, let's call it GBP USD, and it's currently at $40. And from your technical or fundamental analysis, you find out that it would rise. So you immediately open your MT4 or your MT5 app and clicked on buy. And your target for this trade is just 50 pips. You don't want to be greedy. For you to set a target profit of 50 pips, you added it to the price you entered, which was 40. So your TP will be at $90. So anytime the currency pair GBP USD starts climbing and reaches $90, even if you are not online, your broker will close the trade for you automatically using your MT4 or your MT5 app and add the $50 profit to your account immediately. Now, this will only happen if you added a take profit to the trade that you took. And that is how take profit works. Once you set it at a particular price on your MT5, whether you are online or not, it closes the trade for you and lock in your profits. Now, to see where to set your take profits, you can watch the video with the link above so that we can also see a practical example using real pairs. Now let's take a look at Euro USD at the current ask price of 1.0896. Let's say I want to buy the pair and I want a profit of 50 pips. For me to get a TP of 50 pips from that trade, I would need Euro USD to rise to 1.0946 because 1.0896 plus 50 pips, that will give us 1.0946. Hence, I will go to my TP box and type in 1.0946. When Euro USD rises to 1.0946, my broker will automatically close my trade for me and add my profit to my account. Remember, in buying, we are making reference to the ask price, not the bid price. That's why I'm making reference to 1.0896. So when it rises and gets to 1.0946, which will be a 50 pip move, my broker will close the order and keep my profits in my Forex account. In selling a currency pair at the Forex market, you are selling after you have found out that your technical or fundamental analysis that the price would fall. Hope you remember that. So as the price is falling, you are making money. This is the opposite of buying. Now the next one we'll be talking about is stop loss. This is another important form of market order, which is like the opposite of take profit order. Hence, you are giving your broker an instruction to close your trades when the market wants to go against you. Market is always going up and down, and sometimes a news may pop up and sway the market in the opposite direction in which your trade was planned. But with the stop loss order, immediately the market wants to change and go to the opposite direction, your broker will close the trade for you through your MT5, even if you're not online. Now, assuming I want to buy GBP USD at the current ask price of 1.2967, seen in the image, and I want to take profit of 30 pips. What I will just do is to add 30 pips to the former value of 1.2967, and it will be 1.2997. And I want my stop loss to be 10 pips. What I would do is to subtract 10 pips from the former value of 1.2967, and I would have 1.2957. Now my TP is 1.2997 and my SL, which is stop loss, is 1.2957. I hope you understand these concepts. If you do not understand, you can rewind the video back just to understand it better. Selling a currency pair at the Forex market, you are selling after you have found out that your technical or fundamental analysis at that price would fall. Hope you remember that. So as the price is falling, you are making money. This is the opposite of buying. So immediately the price falls from $100 to $55, your broker will add your 45 pips profit to your account. That's the beauty of Forex. You make money both ways. Whether a currency pair is rising or falling, it is none of your business. You just enter in the right direction and make your profits. Let's now see practical example. Let's say after our analysis, we found out that AUD USD will fall. So we decided to short AUD USD pair. Remember now, we are interested in the bid price because we are selling. And the bid price is currently at 0.6741 in the image above. And I want to take profit of 60 pips and a stop loss of 30 pips. What would be the value of my take profit? Now, because we are expecting it to fall, our take profit will be below, not above. So subtracting 60 pips from 0.6742, we have 0.6681 as take profit. Hence, I would input 0.6681 into the same take profit box we use when we are buying. Same take profit box is used both when you are buying or when you are selling on your MT4 app. So in case you are wondering where the take profit box is, use the link above to watch the video and see where to set take profit and stop loss on your MT4 or your MT5 app. Now let's continue. So when AUD USD falls and reaches 0.6681, my broker will automatically close and add my profit for me. Our SL, which is stop loss, will be above, not below, because we are selling. So adding 30 pips from 0.6741, we will have 0.6771 as our stop loss. I know some of you might be confused, but don't be. If you are confused, you can rewind the video back and watch the place where I explain how to calculate pips in Forex. That's why I told you guys that pips is the bedrock of Forex. Everything you'll be doing in Forex calculated in pips. Your stop loss, your take profits, your profit and your loss, everything is calculated in Forex. So if you don't understand that concept, it will be very hard for you to understand where to place your stop loss and where to place your take profits. Now, in order for you guys to understand this concept very well, I will also give you guys an assignment. So for assignment 1, assuming we want to buy GBP USD from the current ask price of 1.2210 and I want to take profit of 45 pips and stop loss of 15 pips, what will be my take profit and my stop loss value? Assignment 2, assuming we want to buy AUD USD from the current ask price of 0.6734 and I want to take profit of 60 pips and stop loss of 22 pips, what will be my take profit and my stop loss value? Assignment 3, assuming we want to sell Euro JPY from the current bid price of 117.55 and I want to take profit of 47 pips and stop loss of 18 pips, what would I input in my TP and my stop loss box? Assignment 4, assuming we want to sell USD CHF from the current bid price of 0.9795 and I want a take profit of 35 pips and a stop loss of 12 pips, what will I input in the TP and SL box? I will urge you guys to all try this and drop the answers in the comment section, because in order for you to understand this concept very well, you need to do some exercises. So do it and give me your answers in the comment section. If you are wrong, I'll let you know and give you the right answer. And if you are right, kudos to you, and I'll also let you know. Now, the next topic we'll be talking about is what is leverage and lot size. Now, what is leverage? Leverage in Forex is the ratio of the trader's fund to the size of the broker's credits. In other words, leverage is a borrowed capital to increase the potential return. The Forex leverage size usually exceeds the invested capital for several times. The size of leverage is not fixed at all companies, and it depends on trading conditions provided by certain Forex brokers. To understand this concept of leverage, let's take a brief history of how Forex was initially. Initially in Forex, it's not anyone that is allowed to trade Forex. Forex are only traded by people we call the cabals, men of Wall Street. Usually investment banks, big businessmen, company owners, etc. etc. Now, during the invent of the internet, the world became a global village. In that, you can buy and sell from anywhere around the world. This led to the proliferation of Forex brokers. Now, Forex brokers had so many customers around the world that they could solve that single problem of capital for us. Now, those world banks requires a certain amount of money for someone to be able to trade with. But because brokers have pulled many amount of money together, we are now allowed to trade through our brokers. So instead of an individual trading with $1 million, you can actually place a trade with as little as $10 because it didn't go alone. You went to the market through your broker, who is recognized by the World Bank as a formidable force because it has a large capital base. I believe this simple illustration is understood. Now, your broker allows you to trade because he offers you what they call leverage in the FX market. The principle of leverage is virtually multiplying that your little capital so that you can use it and buy something worth a bigger value. Example, one will be filling our form for opening of trading accounts, which will be seen soon. You will see things like 1 to 500, 1 to 100, 1 to 2000, 1 to unlimited, or 1 to 100. Some of us who have a demo account, I'm sure that you also saw it when opening a demo account. Now, if you don't know how to open a demo account on MT5, you can watch the video. Click the link up here to watch the video on how to open a demo account on MT4 or MT5 app. Now, a lot of people ask how to choose the best leverage. Which is the best leverage level? The answer to this question is that it's hard to determine which is the right leverage, as it may depend on the trader's trading strategy and the actual vision of upcoming market move. That is, scalpers and breaker traders try to use high leverage as they usually look for quick trades, but as to position traders, they often trade with low leverage. So what leverage should I use for Forex trading? Just keep in mind that Forex traders should choose the leverage that makes them feel comfortable. Most brokers offer leverage from 1 to 100 to 1 to unlimited. Usually in Forex markets, 1 to 100 leverage level is the most used leverage for trading. Now you might be wondering, what is the problem with high leverage? Well, the high leverage, besides being attractive, it is very risky too. Leverage in Forex may cause really big issues to those traders that are newcomers to online trading and just want to use big leverage, expecting to make large profits while neglecting the fact that the experienced losses are going to be huge as well. So how do you manage leverage risks? While the leverage can increase the potential of profit, it also has the capability to increase potential losses as well. This is why you should choose carefully the amount of leverage on your trading account. But it should be noted that true trading this way requires careful risk management. Many traders always trade it with leverage to increase their potential return on investments. It is quite possible to avoid negative effects of Forex leverage on trading results. First of all, it is not rational to trade the whole balance. Example is to open a position with the maximum trading volume. But for beginners like you, the suggested leverage is 1 to 100 for people with small accounts. The second question that many people have been asking is, how much do I use to start Forex? Or how much do I use to make a particular daily target? After this topic, you will have a better understanding on how money is made in Forex. Now the next topic is lot size. What is lot size? Lot size is the amount or quantity of a trade that you bought or sold. It is sometimes called your position size or trade size. In forex markets, these currencies are not bought and sold singly. They are bought and sold in packs called lot size. That is what makes the gain appreciable. If not, your profit in forex would have been $0.001 or something like that. But because you buy these currencies in bulks or packs known as lot size, that's why the gain is appreciable. Let's see the types of lot size. The first lot size we have is called standard lot size, which starts from 1.0, and mini lot size, which starts from 0.1. Then we have micro lot size, which starts from 0.01. There are basically three types of lot size: standard lot, mini lot, and micro lot. Standard lot contains 1000 units and it is represented on your MT5 by 1.0, while mini lot contains 10,000 units and it is represented on your MT4 or your MT5 by 0.1, and micro lot contains 1000 units and is represented on your MT5 by 0.01. Let me use an example to explain complex matters of forex to you so as to make it simpler. Now let's assume we have three traders, trader A, B, and C, that deals on reselling apples. For them to make profits, they can't just buy a single apple from the wholesaler. They need to buy these apples in bags for the profits made to be appreciable. Those bags are what we call lot size in forex. Now, assuming trader A buys 100,000 bags of apples and trader B buys 10,000 bags of apples, while trader C buys only 1,000 bags of apples, you would agree with me that trader A will make more profit than trader B, who will in turn make more profit than trader C. And what determines how many bags of apples they bought is the capital they is invested in the business. This is typically an illustration of lot size. Now, another example. If Mr. A imports 1 container of goods and Mr. B imports 10 containers, after sales, who will make more profits? Mr. B, right? In the illustration above, trader A bought standard lot size, while trader B bought mini lot size. Then trader C bought micro lot size. Let's now see the pip equivalent of each lot size. For standard lot size, 1 pip is equivalent to $10. For mini lot size, 1 pip is equivalent to $1, while for micro lot size, 1 pip is equivalent to $0.1. So if the three traders trade a currency pair and 3 of them made 50 pips, let's say trader A traded with 1 standard lot size of the pair, while trader B traded with 1 mini lot size of the same pair, and trader C traded with 1 micro lot size of the pair. Trader A would make 50 pips and it would be equivalent to $500, while trader B would make 50 pips and it would be equivalent to $50, while trader C will also make 50 pips and that would be equivalent to just $5. So even though they still participated in the same trade and the markets moved in their direction for the same amount of pips, their profits were different because the amount of that particular currency they bought was different. I believe this concept is now clear. Now, for you to trade with 1 standard lot size, you need to have at least $10,000 capital and above. And for mini lot size, you need like $1,000 as capital. And for micro lot size, you need $10 to $100 capital. There is no compulsory lot size to use for any capital you have. We just do it this way just to minimize risks or loss. Now, let me explain further. Let's say, for example, I have $10,000 in my account and you have $500 in yours. We entered the same trades and we went long, which is buy, and we used 1 standard lot. I used 1 standard lot size. You also used 1 standard lot size. And the market started going our way. And after a minute, it reverses back and started selling. Remember that we were buying, so it's now moving opposite our direction. Now, if that trade sells up to 50 pips, your $500 will be gone because it couldn't withstand the retracements, because the 50 pips in 1 standard lot size is equivalent to $500. So your $500 will be gone and the trade will close because you don't have money again. But me that have $10,000, my account will still have $9,500 left. Now, what will happen is that after retracements, the market will start going our initial way, which was long, and I will recover my $500 back and still make another $500 extra because I have enough money while your trade has been stopped. Now, how do we prevent such from happening? We apply what we call money and risk management. Meaning that if you apply risk management, even if you have $100 as capital, you won't lose your money in a single trade. In order for you guys to understand this concept very well, I'll also give you guys an exercise to do. Now, this assignment, when you get it, you drop the answers in the comment section too. Now, assignment 1, if I go long on a pair and make 50 pips with 0.03 lot size, how much will I make in dollars? If I go long on a pair and make 35 pips with 0.50 lot size, how much will I make in dollars? If I go short on a pair and make 90 pips with 0.01 lot size, how much will I make in dollars? And if I go short on a pair and make 90 pips with one standard lot size, how much will I also make in dollars? So when you get the answers, you drop it in the comment section. I will let you know if you're right or wrong. Our last brief topic for today is trading orders. We have instant market execution, we have stop orders, and we have limit orders. Instant market execution simply means that you are buying an instantaneous market price. Let's say a currency pair is presently at $50 and you clicked on buy. What you did was instant market execution because you bought at the current price. While the other two types, which is stop orders and limit orders, is when you are buying at a future price. Let's say you want to wait until the price of that currency pair falls to $40 before you buy. You are no longer doing instant market execution. To see how to set up these market orders, you can watch the video with the link above. It will take you to a different video where I explain it better for you to understand it better. Now let's talk about common mistakes made by traders. This is another important principle in life. It is to learn from other people's mistakes. The first is not having a trading plan. This is the first common mistake made by traders. Next is not using a stop loss. Always remember to put it in all your trades. Technology has made it easier to protect your account. No matter how good you might have analyzed the market, you may not know when a major news would be released and it could change the direction of the market. That is why it's always good to look at the economic calendar before the beginning of every week. But by setting your stop loss, no matter the news, whether it's against your direction, you are always protected. Next is opening too many trades. You see someone open GBP USD trade, Euro USD, USD JPY, USD CHF, all the 28 Forex pairs. They'll open it on the NT5 app just because they want to make more money. There is no way you can monitor all these trades. It all boils down to greed. It's because the person is greedy, because he wants to grab every single pip in the market, which is not possible. Since it's a $7.45 trillion liquidity cap, you want to go home with half of the market value, which is not possible. It is very, very much not possible. Like there's nobody that can do that. So it is better to open multiple positions on one trade, example, one currency pair, and monitor it judiciously than to open multiple currency pair that will distract your attention. Now let's talk about risk management. It is composed of all these topics that we have been teaching in this stage 2. Topics like the lot size, stop loss, trading plan, take profits, etc. etc. It's all a spectrum. Because I told you guys that one standard lot size gives you $10 per pip and 0.1 lot size gives you $1 per pip. You see a beginner trying to use one standard lot size on a $100 account or a $200 account because he wants to get rich overnight. Forgetting that Forex is not a get rich quick scheme, just like a lot of people out there are trying to make it look. So in order for you to become successful in Forex, you need to know how to manage your risk carefully. You don't just go out there and place trades that you are not careful about. You don't know how much you are risking. I don't know how much you are looking to gain. So these are things that you need to put into consideration. And this brings us to the end of this video. So if you know you got a great value from this video, smash the like button, subscribe to the channel, and turn on the notification bell so that YouTube will notify you whenever I drop a new video.